Hello and welcome to the Smart Value Bites. I'm Soumitra Sengupta. The River Nile runs through 10 countries, with the White Nile starting from Uganda and the Blue Nile starting from Ethiopia and merging together and ending in Egypt and the Mediterranean Sea. For those of us who've been there, it's a very picturesque part of the world, and it is flocked by tourists who go there to watch the pyramids and the Nile River running through the Egyptian desert. It's a very, very premium holiday destination for people from all over the world. But this is a finance channel, and so why are we talking as if it was a travel channel? Well, as it so happens that there is a connection between the River Nile and stock market returns. You see, the River Nile is arguably the most flooding or flooded river in the world. It's also the longest river in the world. And in order to cope with the flooding, the frequent flooding of the Nile, the British again, I mean, they ruled over Egypt for some time, decided to build a dam across the river. They appointed a hydrologist named Harold Hurst to determine the possible height of the proposed dam, because the dam should have been built to a height where it is able to prevent water from flooding into the neighboring areas and store it for electricity and irrigation later on. Hurst initially thought that the task would be quite easy. He assumed that the water levels on the Nile year on year followed a normal distribution. And so all he had to do was to determine the height at, say, 3 sigma from the mean, and the possibility of water levels breaching that height would be negligible. But when he looked at the data, much to his surprise, he found that the data did not represent the normal distribution at all. Instead, he found extended distributions with the frequency of extreme observations being far too common. The data was, in other words, following what is called a power law. In addition, the distribution appeared to have long-term positive autocorrelation, which means that high-value observations tend to be followed by other high-value observations. And the future probability of high-value observations subsequent to high-value observations tend to be high and tend to rise. This phenomenon is represented by what is called the Hurst exponent, which quantifies the relative tendency of a time series to either regress strongly to the mean or to cluster in one direction. How is this relevant to stock markets? Well, as a matter of fact, quite a lot. You see, stock return distributions, like the flooding of the Nile, also follow power laws, with clusters forming, resulting in extreme observations. Let's take an example. The diagram represents annual Nifty returns since the year 2000. You will notice that while frequency of occurrences are maximum around the mean, they again spike up at the extremes. In this case, out of the 24 years that we've looked at, mean returns were around 11%, but there was one year when the return was less than 40%, which is a very, very extreme measurement, and 2 years when the returns were more than 70%. This is a very small sample, but it nevertheless highlights the high frequency of extreme observations. What is the lesson investors can draw from this? Well, firstly, markets have positive autocorrelation, which means that high values are followed by other high values. And similarly, low values are followed by other low values. And when I talk about low values, I'm talking about negative returns. This autocorrelation and clustering of observations, high observations and low observations, cause trends. So this results in the existence of trends. And so one of the ways to invest in the markets is to identify these trends and ride them. If you are able to do that consistently and successfully, you will do very well by the market. Thank you.